In this exercise, we're going to talk about a variety of different accounts. We're going to categorize the accounts and we're going to determine their normal balance. So just as a reminder, when we're talking normal balance, this is what type of entry it takes to increase the account. Now you may recall we had the mnemonic, we had the dead mnemonic telling us that the debit accounts include expenses, assets, and dividends, DEAD. And then we had another mnemonic, either clerk or Clark, it's CLRC. That tells us that the credit accounts include liabilities, revenues, and capital. So those mnemonics tell us what the normal balance of the account is, and therefore what we would need to do to increase that account. So let's take a look at prepaid insurance. Prepaid insurance is an asset, and this reflects the fact that we have paid insurance in advance and we're going to be able to use it over time. So instead of having cash, we now have prepaid insurance. So for this first one, we will pull down the account type. It's going to be an asset. Assets have a normal debit balance. That is the A in the dead mnemonic, DEAD. Assets have the debit balance. Then we get to the salaries expense, and the name pretty much gives it away. It is indeed an expense account. Expenses have a normal debit balance. That's the E in the dead mnemonic. Rent expense, again, that's going to be a repeat. That's still an expense. Still has a debit balance. Then we get to accounts payable. Accounts payable, generally when you see the term payable, we're talking about a liability. We owe somebody something. That is the L in the clerk mnemonic, the CLRC. They have a normal credit balance. Interest income would be a revenue account. It's income, it's revenue. Revenue is the R in the clerk mnemonic, so that has a normal credit balance. Tuition fees earned, this is just another name for a type of revenue account. Again, that'll be a credit again. Now this one we have to think about for a bit. We'll talk about this in the adjusting entries. The unearned revenue is actually a liability account. Unearned revenue means that yes, we've received money, but we have not yet earned it. Therefore, we cannot count it as a revenue. We have this money and we owe the customer something until we've provided that service. So it is a liability, and as such, we'll have a credit balance. Cash is an asset. Assets have the normal debit balance. Inventory is also an asset, therefore a debit balance. Land, a long-term asset, but an asset nonetheless, with a debit balance as well. Supplies, it's one of the other assets a company can have, also a debit balance. So then we have accounts receivable. These are funds that we will be receiving in the near future because of something we sold to a customer. They are also an asset, have a debit balance. Office equipment, yet one more asset with another debit balance. And then we get to common stock. Common stock was one of our capital accounts. So that would be an equity type account. And it has a normal credit balance. And then finally, the amounts withdrawn by owners. These are dividends. This is just a description of what a dividend is. Dividend, that is the last D in the dead mnemonic, so it has a normal debit balance. Understanding the normal balances of accounts is critical. It's key to continuing on in the course. You want to make sure you understand which accounts are which type and what their normal balance is, so you can properly do the journal entries throughout the rest of the course. So hopefully this little refresher or practice has helped to clarify some of those for you.